Hey guys, what is going on? Welcome back to the portfolio. As I do with every video, I want to say thank you to all the supporters on the channel, all the subscribers, all the viewers. Immensely appreciate the support. Again, if you guys have any great video content ideas, please let me know in the comment threads down below, and I'll do my best to get out a video for you guys. And if you are new to the channel, feel free to like, share, and subscribe. And if you are subscribing, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. For today's video, in response to a number of different viewers, I want to go through what some of the options trades on the portfolio have been with real numbers from the portfolio. I know that's been a very interesting topic for a number of new viewers on the channel. Options trades are quite complicated. If you are new to options trading, take a look at some of my prior videos on the front page of the channel. Go through some of the basics behind options trades. I'll go through the trades I've made on the portfolio, primarily with AT&T. Posted a video about a month ago or so talking about what stocks I like to do options trades with. Take a look at that video. But essentially, AT&T has the stock I've been doing the majority of the trades with. I've been making some decent income as well, as we'll talk about in the video. First, let's talk about the performance for today. As you can see here up on screen, a very good day of trading. 2301, 1.12% during active hours trading. It is trending a bit down here in after hours trading, but overall a very good day of trading. Current portfolio value just over $208,000 as well. Nice dividend payment in the middle, as you can see with AT&T. T will pay a dividend of 51 cents per share on Friday, February 1st. If we click on that banner, you can see I had 900 shares, 51 cents per share dividend payment for a total dividend amount of $459. So another very good reason to hold AT&T. I like it as a buy and hold stock. I think the price right now is very attractive. There will be some issues moving forward with some of its cable business, but overall I think it's still a very solid company, very good earnings, and I think it's going to be maintaining its dividend over the longer term. So let's now scroll down to options. You can see a number of different options. On the left, you can see the stock, ticker symbol, with the strike price, as well as the type of option. If you guys are new to options trading, take a look at my prior videos discussing some of the basics behind what all of these different trades mean. For the orders I have here, these are all sell orders. So I sold contracts to other investors. When you sell a contract, you get an options premium credited to your account. So all of these I essentially sold off. I'm required to complete these particular transactions if the strike prices are met. A very quick review: if it's a call order, I'm required to sell at the strike price. So for example, the first one here, AT&T $31.50 call. If the price of the stock gets above $31.50, I'll have to sell it to another investor for $31.50, and presumably the investor can then sell that off and make a profit. So I really don't want the stock to get above $31.50 on call orders. For put orders, it's the opposite. If the stock price gets under the strike price, I will have to buy the stock for that price. So essentially, the investor can sell it to me more than what the open market price is. So for example, T, $30 put, I'll have to buy the stock for $30 if the stock gets under $30. So again, I don't want the price to go under 30. So essentially, I'm anticipating the stock will stay about the same. All of these contracts will then not execute. I'll keep the options premium, and then again, next week put in more options orders for more income. So you can see all of the options here. On the bottom, I have a couple other options as well: IRM, Iron Mountain, and KHC. Those will not be described on this video. I want to go through the options trades that are expiring tomorrow. You can see on the left there, expiration 2/1 for all of the AT&T contracts, as well as one Ford contract. The AT&T contracts alone is $551, so essentially $551 for the week. An added benefit is with the Ford contract here, $8.50 put for an additional $13 for that contract. So a very good amount of income that you can make per week. Again, it requires a little bit of capital into the stock for call sells, and then for put sells, they are covered puts, so you have to have that capital available to potentially buy the stock at that price. There are no naked orders in the application here in Robinhood options trading, meaning you have to have the stock in your portfolio if you do a call, and you have to have cash to cover any potential put assignments being assigned to buy the stock in the portfolio as well. Let's go ahead and go through the orders here to show you the numbers. So for this particular stock here, if we scroll down to the bottom, you can see that I sold off the contract, 2 contracts, 31 cents per contract, $62 was credited to the account. Up on top here, for new viewers on the channel, you can see I have negative 2 contracts, again, meaning I sold off the contract, I'm down 2 contracts. Market value is $2. What that means is that if I want to buy these contracts back, I'd pay $2 and essentially make $60 total return, as you can see in the middle there. Plus 60, 96.77% in the positive return total. Again, simply taking the payment here, $62, minus the current price of those options, $2. So I could do that now, or I could wait to have the options contract expire, and then I'll keep the total $62. If we scroll over $31 call, if we scroll to the bottom of this particular options contract, you can see I sold 3 contracts off 52 cents per stock. Each contract is 100 shares, 100 stocks. So 3 contracts, 300 times 52 cents, 156. Again, in a similar fashion, if I wanted to buy these contracts back, they're each worth $1. So it would be negative $3. If I bought those back, it'd be $153 for total return. Again, simply the price that I was credited for selling those contracts off minus the price that I buy those back with, $3. So 156 minus 3, 153 for total return. Next contract here, $30 put contract. Again, on the bottom here, you can see the options premium, 1 contract, 49 cents per share, 100 shares per contract, $49 credited to the account. Here's that Ford contract that we went through, $13 on the bottom, as you can see, 1 contract. AT&T $30.50 put contract. A number of different days that I sold these contracts off. 2 contracts at 51 cents per contract, 102 credited to the account. 2 contracts, 63 cents, 126 to the account, and 1 contract at 56 cents. So $56 credited to the account. Again, if I wanted to buy those contracts back, all 5 of those contracts, I'd have to pay $240. The total return would be $44. Again, the total options premium minus the amount to buy those contracts back. Then here are those other 2 contracts, a different strike date. You can see on the top there, expiration date 2/15, strike price $35, and on the bottom here, $55 credited to the account. And the last one here, KHC, on the bottom you can see $70 was credited to the account, 1 contract. So very good dividend income, or I should say premium income to the portfolio. I consider it a dividend payment for all of the put and call contracts. Again, let's go back to the main screen here to do an overview of all the contracts. Again, on the left you can see the strike dates, expiration 2/1 for the majority of those contracts, minus the IRM and KHC on the bottom. And then there are a number of call contracts. Again, I'm required to sell a stock if the price of the stock gets above the strike prices on the day the option contract expires, which will be tomorrow. And for the put contracts, if the price gets under the strike price on those contracts, I'd also have to buy the stocks for that particular amount of money. On the right there, you can see a lot of negative numbers, rather large negative numbers. That is a good thing with options trading, especially when you're selling off contracts, essentially meaning it's going to be a lot less to buy those contracts back. So like I mentioned in the particulars on every one of these contracts, you can go ahead and buy and sell these just like you would a stock. So you can go ahead, sell off a contract, get the options premium, and then buy it back at a lower amount, making the difference and then entering into a new options contracts. A lot of traders do that. I simply buy these contracts and wait for them to expire. The other big thing, or important thing, at least for my options contracts trades, I'm more than happy to do any of these particular transactions. If I had to sell off a stock at $31.50, that first AT&T contract there, more than happy to do that. I bought it for less, so it would still be a positive swing trade, as well as the options premium. Yes, if the stock did trend up to $40, for example, I would lose a lot of that upside potential. But for the trades I do, and because I do these trades every week, potentially making $500–600 per week, more than happy doing that. Likewise, let's take this $30 put contract here. I'm more than happy buying AT&T at $30 per share. I think the stock is undervalued at this point. It's got a great dividend income, dividend yield as well, above I think 7% now, at least in the 6% range. And I think it has a very good likelihood of maintaining that dividend. It is a dividend king stock with a very long track record of dividend payments in the past. So I think this is a very good stock for any investor to jump into, buy and hold. Yes, there are some difficulties that will probably come next year, but I think overall it's a very good stock to get into. So I'm more than happy, again, buying the stock at $30 per share. And likewise, this contract here, $30.50 put contract, I'm more than happy jumping into the stock at $30.50 as well. And if I do have to buy the stock for $30.50 and $30, what I'll do is simply put in another call contract next week, selling the stock off at either that price or at a higher price. So I'll make, at the very least, a contract trade. I will buy a stock at, for example, $30.50 and then sell it off for $30.50, making options premiums on each of those contracts. And if I was able to sell it off for more, I would also have a positive swing trade with that transaction as well. So that's how I've been making income on the portfolio, passive income on capital that you have in the portfolio as cash, as well as stocks that you have sitting in the portfolio already. You can still make the dividend income off those stocks, then also make a passive return on the call contracts that you sell off as well. So overall, the dividend yield probably, if you consider with the options premium, is around 15 to 20% or so. Again, all of these contracts won't expire. Some of these will be assigned. You will lose a little bit of money if they are assigned, just because you'll be buying a stock for higher price than what it's currently worth, and you may have to sell off a stock for less than what it's currently worth. So you're going to be missing a little bit of income on both of those trades. But if you're more than happy to jump into the stock for the longer term, put contracts are no issue. You can sell off covered calls after you buy the stocks. And if you do have stocks in the portfolio that you bought for a particular price and you do sell off a call contract and are required to sell off the stock, it's okay. You will lose that upside potential, but it's not a negative trade in any sense of that trade, because you got an options premium and you sold it off for the same that you bought it for, or maybe even a little bit more than you bought it for. So again, just wanted to quickly go through this. I know I went through this very quickly. Options contracts are much more complicated than simply buying and selling a stock as you normally would on the open stock market, but it has a lot of potential for premium income on stocks you have in the portfolio. And then if you have cash sitting in the portfolio, you don't necessarily want to start a position, but you're okay with starting a position at a particular price of a stock, you can put in a put contract, so you get the options premium. If you have to buy the stock for that price, you buy the stock, it's okay. You wanted to put that stock into the portfolio anyway. If it expires, you still keep that options premium, and then you can put in another put contract the next week. So again, just wanted to quickly go through that for interested viewers on the channel. Again, for AT&T, $551 this week. All of these contracts will be expiring tomorrow, so I'll do an update on the actual profit that I make. Current profit is $551 if all of these contracts expire, are not assigned. But some of these may be assigned. If they are assigned, I'll calculate exactly what the profit is on these trades. So again, thank you to those viewers suggesting this video. I know this is, again, a very interesting topic for a lot of you guys that are jumping into the Robinhood platform, especially jumping into Robinhood options for the first time. You can make quite a bit of money with options trading, but be careful. It is much more complex than simply buying and selling a stock as you normally would on the open stock market. So don't want to make the video too long. I'll kind of end it here. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. Until the next video, we'll see you then.